If you look at equities versus credit, which looks more attractive as a risk proposition right now?
Well, I think we do see these pathways to a much stronger upside, but I think you have to recognize that a lot of the policy is not being determined by the emerging science. Eventually it will be, but right now it's still very political, and so the political outcomes about lockdowns and things can be very different. And in some of these in the central scenario, we do see the risk reward for credit still more attractive. So kind of buy where the Federal Reserve is buying. We like investment grade, we like U.S. high yield, and we also like the emerging market dollar-denominated sovereign debt.
Okay. In terms of volatility, go ahead.
Well, and I was going to say, but one of the clear trends that is emerging from this is the success of sustainability, both on the equity side and also on the green bond side. That is a trend that we see our clients really gravitating towards, both because it's aligned with their long-term view, but also because of the success of those assets through this crisis.
Got it. So we've talked quite a bit about the potential for upside and where you would take those opportunities, Mark. What about the downside risks? What's the protection you would put in the portfolio to deal with that?
Well, one of the things that many of our clients are looking to is gold. And the reasons there, I think, are concerns about the growing pile of debt that is being added globally by governments, and also the chance that the dollar has seen a spike in this kind of crisis stage, but the dollar could weaken given the fiscal and monetary stimulus being applied in the United States. So gold is one asset. Now, unfortunately, the role for bonds, as we all know, is going to be somewhat diminished going forward, and the role it can play as an asset allocation stabilizer simply because yields are so low. And if you get it wrong, you're almost guaranteed to destroy value. And so there we have to look to alternatives. There still can be a role for hedge funds, which are not as correlated to either stocks or to bonds, to provide some portfolio stability.
Yeah, it's interesting what you say on bonds, Mark, because the volatility in treasuries particularly has been so subdued if you look at the MOVE index. But you were talking earlier when we were discussing US-China relations about the prospect for more volatility ahead. And I believe you were referring mainly to equity markets. If you are expecting more volatility ahead, how do you think investors should take advantage of that?
Well, this high volatility has led a lot of clients to look for structures, right, where they can earn a yield, but then kind of benefiting from behavioral economics and kind of say, I'm willing to buy into the market if we get volatility down to a certain point, but I'll earn a yield in the meantime. And so we are seeing a lot of clients try to look for those, to use structures, to, selling options to try and get a yield now, but also position themselves to get in or out of the market should we see a big volatile move.